they asked Jim, what interest rate? Because, all right, let me back up. What ultimately happened, and the reason why we have so few transactions going on right now, is because interest rates were in the 2s and 3s, and now they're in the 6s and 7s, and they got as high as into the 8s at some point. So there was a multi-point variance there, right? That's why the housing market basically just really didn't stop, but it came to a grind, let's say, right? The number of transactions came to a grind. So the question to Jim was, all right, they analyzed all these different factors. Everybody kind of agrees that it's interest rates that are going to unlock the housing market. And the financial people who report for the Wall Street Journal are so interested in this because the housing market makes up about 15% of GDP. It is a massive economic driver of our economy, right? When you think about all of the services that come into play just on the transaction of a home, when somebody new moves into a home, maybe they want to do different paint, different carpet, all these things. It's an economic driver, right? So a lot of industries are sucking wind right now. So everyone's interested to know, how is this thing going to get unlocked? And the consensus is it really comes down to interest rates. And we're going to hear in a minute from Amy Green from Quintessential Mortgage about interest rates and what she feels the bond markets are doing, so on and so forth. However, what he said, and I agree with this. I've been saying this now for a few months. I feel 6% is a key marker, and so does Jim. You'll hear it in his video. He says if the rates can consistently be at or below 6%, he really likes to have a 5 on the number, 5 point something, right? He feels that if the interest rates can hover there and give people confidence that they're going to stay there, the market will unlock and transactions are going to come back in a big way. And I agree with that because by and large, there's a lot of equity on the table in the country right now. The total mortgage debt versus the total asset valuation of homes there's a great variance between those two, which is great. It means it's healthy. There's a healthy amount of debt out there that's not going to stop things from happening. In general, people are continuing to spend. Incomes are generally on the rise. Unemployment rate is relatively low. So there's a lot of good fundamental factors in place that if interest rates just kind of continue to come down and can get into that high 5 area, low 6 area, it should unlock the marketplace. Now, one other question that I thought was great was, Jim, if you were in the market to buy a home, would you buy right now or would you wait a little bit? And I thought that was a great question. And he said he really didn't hesitate. If you watch the video, you'll see. He said, yes, I would, provided that I was going to stay in place for at least 5 years or more, right? And his point there was, well, look, if you're renting, you're not paying down a mortgage. You're just paying rent. You're paying down someone else's mortgage, right? We all know that in the real estate industry. That is so true. The other point that he made was rents are going up too. It's not just housing prices that are going up as well. So if you're going to rent over the course of 5 years, the rent that you're paying is not going to stay the same. It's going to continue to go up because there's a general housing crisis in our country overall. So I just thought it was great to hear that Jim himself would buy a home in today's market if he was in the need to do so.